Welcome back to the deep dive. So today we're jumping into something that, well, often feels pretty complicated, maybe even a bit intimidating. Personal finance, wealth building, all that stuff.
Yeah, lots of jargon out there. It can feel overwhelming.
Exactly. And our source material for this is a really great summary of J.L. Collins's book, The Simple Path to Wealth.
Uh-huh.
You've probably heard of it. It gets talked about a lot because it promises to, cut through all that noise and confusion.
Make it simple, approachable.
Right. Make building wealth genuinely doable for, well, pretty much anyone. Doesn't matter where you're starting from, financially speaking. So our goal here, our mission, if you like, is to really pull out the most important bits, the key takeaways from this book. Think of it as a shortcut, maybe, helping you figure out how to get a real grip on your money and start moving towards that financial freedom idea.
And that's really the core promise, isn't it?
Yeah.
A simple sort of no-nonsense guide, which honestly is so refreshing when you're constantly bombarded with conflicting advice and all these different financial products.
Totally. It's a lot.
So yeah, we're going to break down Colin's whole approach today. We'll look at it in four main parts, try and make it super clear, super actionable for you.
Okay. Sounds good. Let's get into it. So part one. It's really about getting the foundations right, isn't it? Getting your financial house in order.
Absolutely. Collins really hammers this home. It sounds basic, but maybe it gets overlooked sometimes. You have to consistently spend less than you earn.
It's not just like a friendly tip. He frames it more like a law of physics for money.
Yeah, the law of financial gravity, as he puts it. And right alongside that is getting rid of high-interest debt aggressively.
Especially that credit card debt, right? The really nasty kind.
And one of the key things he says, which is quite blunt, is that you just cannot outinvest bad spending habits. It won't work.
So if money's just pouring out faster than it's coming in, no fancy investment is going to save you.
Pretty much. It really makes you stop and think, doesn't it? What are we actually trading away when we pick that, instant gratification purchase?
What are we trading?
Collins argues it's our future, our long-term freedom, the choices we'll have down the road.
Wow, okay, so it's not just about the money spent now. It's literally sacrificing future autonomy, the ability to decide things for yourself later.
Precisely. And he sees that high-interest debt, especially credit cards, as more than just a drag. It's like this active force just eroding your financial future.
Yeah, he doesn't sugarcoat it at all. And he makes this really stark comparison, paying off, say, a 20% interest credit card. He says that's effectively like getting a guaranteed, completely risk-free 20% return on your money.
Which is huge when you think about it like that.
It really is. The insight isn't just avoid debt because it's bad. It's paying off this specific debt is probably the best investment you can possibly make right now.
Yeah, better than anything the market could reliably offer, guaranteed.
You just won't find that kind of guaranteed return anywhere else. It puts you way ahead before you even start thinking about stocks or bonds.
And framing it as a guaranteed return is, well, it's powerful. It changes debt repayment from feeling like a punishment
Right, like something you have to do.
into an active, smart, even profitable investment strategy. It flips the whole perspective, makes it feel empowering, like a positive first step you can take.
That reframing is such a key mindset shift. It genuinely makes you reconsider where your money should go first.
Yeah.
And this flows perfectly into Collins's second big piece, his core investment strategy.
Okay.
Now, this is where he keeps things really straightforward, maybe surprisingly so for some people.
Yeah.
It's all about low-cost, broad-based index funds.
Yeah, forget trying to pick the next hot stock or figuring out when to jump in and out of the market.
Exactly. He's suggesting a much simpler path, one he argues is actually more effective for most people.
And if you connect that to the bigger picture, it's about getting incredible diversification right. Instead of putting all your eggs in one or even a few company baskets, you're essentially investing in the entire U.S. economy, or even a global one, depending on the fund.
And he specifically shouts out Vanguard's Total Stock Market Index Fund, VTSAX.
All right, that's the mutual fund version. Or VTI, which is the ETF, the Exchange Traded Fund. They basically do the same thing.
And what's in them?
Essentially a tiny slice of almost every publicly traded company in the U.S. The big, established giants, the smaller up-and-comers, everything.
So you're not betting on Apple or Tesla specifically. You're betting on the overall long-term success of American business.
That's the idea. You're betting on the whole haystack, not searching for the needle.
And the real kicker, the beauty of it, is the cost, right? These expense
Yeah,
ratios.
the fee the fund charges you each year,
They're incredibly low, especially with Vanguard. We're talking fractions of a percent.
which means way more of your money stays invested and growing for you instead of disappearing into fund manager pockets or trading costs.
And here's the mind-blowing part.
Hmm.
Historically, this super simple, low-cost approach, it's actually beaten the vast majority of professional money managers who are trying to pick stocks and time the market.
It really has.
Mhm.
It's kind of a testament to just keeping it simple, being patient, and letting the market do its thing over the long haul.
It does make you wonder, doesn't it, about the whole active management industry.
Right. If these simple funds consistently do better, what exactly is the value add of all that complexity and perceived expertise we often pay so much for?
It's a humbling thought, definitely. Maybe the smartest move is just to, well, get out of your own way and trust the long game. And speaking of trust and maybe getting out of your own way, that leads perfectly into part 3. This is about the psychology, taming your emotions.
Ah, yes, the mental game.
Hmm.
Because investing isn't just spreadsheets and numbers.
Not at all. It's an emotional roller coaster sometimes. And Collins is very clear. The stock market, over the long run, it always goes up.
But it's going to be a bumpy ride getting there. There will be drops, big ones sometimes.
Guaranteed.
And his key insight here is how to view those drops, those market crashes and recessions.
Mhm.
He basically says, they will happen. Expect them.
But don't fear them.
Exactly. Don't fear them. See them as an opportunity. When the market tanks, he doesn't see disaster. He sees a sale.
A sale, like stocks are on discount.
Pretty much. It's a chance to buy more assets, more shares of your index fund at lower prices, which significantly boosts your returns when things eventually recover.
And this is where that dollar cost averaging thing really shines,
Yeah.
right?
That's just the discipline of investing the same amount of money on a regular schedule, say every month or every payday, regardless of whether the market is up, down, or sideways.
So you don't even think about it.
You don't. It's automatic. It means you naturally buy more shares when prices are low because your fixed amount buys more, and fewer shares when prices are high. It averages out your cost over time.
And crucially, it stops you from trying to guess the market's next move, which is usually a losing game.
Totally removes that emotional temptation to panic sell or greedily buy at the top.
So what this means for you, the listener, is no matter what the headlines are screaming about the market, you just keep putting that money in every month or every 2 weeks, whatever your schedule is.
Make it automatic if you can, from your paycheck straight to your investment account.
It's the ultimate set it and forget it approach, really. Let your logical plan override your fearful or greedy impulses.
Imagine the peace of mind that comes with that. Knowing you're building wealth systematically without agonizing over every daily dip or spike.
And if you stick with that discipline, you build a really solid base over time. Then when the market inevitably does bounce back, and history shows it always has.
You're positioned so much better. You bought shares on the way down, you bought at the bottom, you bought on the way up. It's about discipline over panic.
It's such a counterintuitive move when everyone else is running for the exits, isn't it?
It really is. While others sell low in fear, the people following this simple path are effectively buying low, accumulating more assets when they're cheapest. It's a powerful lesson in emotional resilience and just having that long-term vision.
Okay, so we've covered spending less than you earn, getting rid of bad debt, investing simply and consistently, and keeping your cool during market swings. Which brings us to part 4, the destination. Why are we doing all this?
Right. What's the point of all this discipline?
Collins wraps this up with a pretty provocative phrase. He calls it FU money.
Huh. Yeah, it definitely gets your attention.
It does. But he's quick to clarify, it's maybe not what you immediately think. It's not about buying yachts or being flashy.
No, not about extravagant spending.
It's about freedom, real freedom, the power to just walk away from situations that aren't serving you.
Like a job you hate.
Or a toxic boss, yeah. Or just the constant pressure of living paycheck to paycheck, feeling trapped. It's having enough financial cushion to say no or I'm done without facing immediate disaster.
So it fundamentally redefines what financial freedom looks like. It's not about luxury goods, it's about control.
Exactly. Control over your life, control over your choices, and maybe most importantly, control over your time. That's the most valuable asset we have, right?
Absolutely. It's the freedom to maybe take a lower paying job you actually love, or take a year off to travel or start your own thing without being totally dependent on that next paycheck. It's real autonomy.
And he doesn't just leave it as this abstract concept. He gives a practical way to figure out how much you need to achieve this. The 4% rule.
Ah, yes, the guideline for financial independence.
And the math is surprisingly simple. You figure out roughly how much money you need to live on each year.
Your annual expenses.
Right. And then you multiply that number by 25.
So a quick example. If you figure you need, say, $40,000 a year to live comfortably.
Multiply by 25. That's $1 million.
So $1 million is your target number to have invested.
And once your investment portfolio reaches that number, according to this rule, you are financially independent. You can, in theory, withdraw 4% of that, $40,000 in this case, each year to live on, and the portfolio should sustain itself indefinitely, adjusting for inflation.
Obviously, there are debates around the edges of the 4% rule, but it provides a really solid target, a finish line.
Yeah, it makes the goal concrete. You know what you're aiming for. You've essentially won the financial game at that point by Collins' definition. So, okay, let's recap this whole thing. The core message we've distilled from Collins's work seems incredibly straightforward, doesn't it?
Deceptively simple, maybe?
Yeah. Spend less than you earn. Always. Invest the difference. Simply think low-cost, broad-based index funds, and just be incredibly consistent. Stay the course.
Don't get fancy, don't panic.
Exactly. And following that path, the one he lays out, it really can lead to a life with significantly more freedom and choice. It brings back that powerful idea of FU money as the ultimate goal. Again, not about stuff, but about control. Control over your life, your decisions, your time, and having that 4% rule as a kind of practical compass to guide you towards that independence number.
And it all ties back so neatly, doesn't it, back to tackling that financial monster of high-interest debt first.
Right, seeing it as that guaranteed return.
And then embracing the almost Zen-like simplicity of just buying the whole market through index funds. It really highlights how important just thinking critically about your own finances is. Collins really encourages that. It's essential in the complex world we live in.
Absolutely. So maybe a final thought for everyone listening. Given the simple path we've just walked through, what's maybe one smarter choice you could make this week? Something small, even. That starts trading a bit of that instant gratification for more long-term freedom down the road.
Or maybe looking at it from the debt angle.
Mm-hmm.
Is there one high-interest debt you could really focus on tackling first? Start seeing those payments not as a chore, but as banking that guaranteed risk-free return Collins talks about.
Yeah. Because the whole journey, no matter how big the goal seems, it always just starts with one simple step.